In this video, we are going to look at stop losses. What is a stop loss? This is also covered in the free intro to trading course. However, we will touch on it again here. Why are stops important? 3 different types of stop and considerations when choosing a stop. Let's start by asking what is a stop loss and why are they important? A stop loss acts as your safety net when you are trading. You set it a predetermined distance from your trade entry. If the market moves against you, the stop loss removes you from the trade at that level, limiting your loss. So if you set your stop 100 pips away and are risking the equivalent of £1 per pip, it will limit your loss to £100. Always use a stop loss when trading. Most brokers even offer a guaranteed stop loss, which means you will only ever lose the amount specified by your stop loss. There is more information on stops, money management and risk management in the free intro to trading course. Without a stop loss in place, the market may move against you enough to wipe out your entire account. In rare circumstances, it may even leave you in negative equity because you are using leverage. A stop loss also allows you to leave the screen. If you do not have a stop loss, you need to be there to exit your trade manually if it moves against you. With a stop loss, it will do it automatically. This is very helpful, especially if you are holding trades for hours or even days at a time. A stop can also help protect against emotional trading. This can happen when you do not want to accept the loss and so you convince yourself to hold it because surely it will move back into profit eventually. Of course, this can lead to disaster. A preset stop loss takes the decision out of your hands and pulls you out of the market at your risk tolerance. Without a stop, you cannot work out your risk reward on trades and so determine the profitability of your trading strategy. If your risk changes from trade to trade, it will become increasingly difficult to become consistently profitable. Again, risk reward is covered in the free intro to trading course. Now let's look at 3 different types of stop. A stop is a stop is a stop. It is there to take you out of the market and limit your losses. However, people tend to favour different variations on the stop. We will look at tight stops, large stops, and structure stops. Remember, your risk is always the same. If you are risking £100 per trade and your stop is 10 pips, then you simply risk £10 per pip. If your stop is 100 pips, you risk £1 per pip. However, the stops above are all very different and all have benefits and drawbacks. We will start with the tight stop. A tight stop would be one that you place relatively close to your entry point. So on this market, let's say we use the green pin bar as our entry. We place our stop just up above the high of the candle here. Some of the benefits of this style of stop would be you can achieve good risk reward levels on trades with relatively small market movements. If your stop is only 20 pips, the market only needs to move 20 pips before you are at 1-to-1 risk reward. Small stops can benefit people who are only risking small amounts on trades. If risking £20 per trade, then at the equivalent of £1 per pip, you can only have a 20 pip stop maximum. What about the drawbacks? You tend to suffer more losses than with a larger stop. A small stop doesn't allow for a lot of normal market movement before stopping you out. That means you are more likely to be stopped on trades that would still work in your favour with a larger stop. In this example, you can see the market has pressed back up and stopped us out, but then starts the strong sell that we were looking for when we entered the trade. Now let's look at a large stop. For this example, we will say we enter after this bearish candle. We are using a large stop, so we place it a large number of pips from our entry all the way up here. What are the benefits of this type of stop? It gives the market more room for normal movements without stopping you out. Think back to our previous example, where the market stopped us and then carried out the bearish move we were expecting. It can be useful if you find you are not very accurate with entries. If you find that the market very often chops above or below your entries and then gives the expected price movement, then a larger stop can help protect your positions from unnecessary losses. What about some drawbacks? It takes much larger market movements to reach good risk-reward levels than when using a small stop. If your stop is 100 pips, the market has a much larger move to make before you reach 1-to-1 risk-reward than if your stop is 20 pips. Some people use very large stops and take small winning trades, using a different risk-reward strategy. However, this means that a lot of winning trades can be wiped out by one loss. For example, they may use a 100 pip stop and only look to make 20 pip profits. However, this means that you can have 5 winners in a row and then one loss wipes them all out. Finally, let's look at the structure stop. This would be using previous market movements and swings as your clue to placing your stop. Let's say this bullish candle is your entry. You would then look to place your stop below a strong previous swing and would place it here. What are the benefits of this style stop? You are using market levels rather than some arbitrary number to determine a stop. It can help make sense of a trade. If trading a bullish trend, for example, you are looking for a market making higher highs and higher lows. If it starts to make new lows, it is likely your sign to exit the trade. Your stop then takes this into account, rather than just using a fixed number stop, which may end up sitting above that swing level. The drawbacks? Your stops tend to be quite large. Similar to the previous large stop, key price swings are often a fair distance from your entry. The markets often stop hunt at these levels, because so many traders place their stop in the same areas. You often see a strong move down below that previous swing to clear out the stops before the bullish move then comes in. It can be difficult deciding what level of structure is important when deciding the stop. In our example, why not below this swing to be safe? It seems important. Why not the swing below here? It can seem confusing, right? Which stop is best? The truth is, no one way is best in any aspect of trading. It should all suit you and, most importantly, your trading plan. Considerations when using a stop. Does it suit you? First and foremost, you must have a stop and trading plan that suits your trading personality. If you use a tight stop, but find the extra losses cause you to make mistakes and trade emotionally, then it is no good. A plan is only as good as the way you execute it. Similarly, if you use a large stop, but find that the big loss wiping out a lot of your previous wins causes you to get frustrated and make mistakes, then it is no good. Does it suit your trading plan? It must also fit with your trading plan. If you are using a tight stop because you want big risk-reward trades, but your trading plan and execution gets you into an overwhelming number of trades that stop you out before you reach those risk-reward levels, then it is useless. If you use a structure stop, but find that you keep picking incorrect levels and struggle to identify swings, then it is also no use.